5 financial mistakes keeping Aussie families stuck. After working with Australian families for over 20 years, the people who are doing all the right things, earning decent money, putting money into a savings account, working hard, are all feeling stuck. And most of the time, it's not because of bad luck, it's because of these 5 financial mistakes that are keeping families feeling stuck, treading water, not making any progress financially, with no light at the end of the tunnel. In this video, I'm going to teach you how to fix all 5 mistakes. Even if you can only fix one of the mistakes, you're finally going to feel like you're moving forward and making financial progress. Mistake number 1, making minimum monthly repayments. Now, who wants us to be in debt for longer? The banks and brokers or you? Probably the first. We all know everybody else makes more money the longer you're in debt. And so the best way to keep people in debt is to tell them to make the minimum repayment on their mortgage each and every month. Now, the lower your repayment, the less coming off the principal, and as a result, the longer that loan term. Most profit for these banks is made in the first 3 to 5 years. And so every single loan set up gives you your minimum repayment. And if you make that minimum repayment, that's going to keep you in mortgage prison for the maximum amount of time. One thing we've learned over the last 23 years of doing this every single day is if you aggressively attack the principal in the early years, just like that compound interest, but in reverse, you're going to get a snowball effect, an avalanche of debt reduction, and all of a sudden you can start creating equity faster than you've ever done before. Getting advice around finance and structures and loans, who am I getting the advice from? What's their vested interest? What's their financial incentive? Now, most banks and brokers make more money the longer you're in debt. So is the advice that they're giving you and the structure that they're advising you to take out going to help you pay your house off faster or slower? Are those structures built to help you or the bank? We all know if you're a bank making $10,000 million per year or $10 billion per year, just like CBA, you've got every loophole covered. You know the best way to profit from mums and dads around Australia is to keep them in debt for as long as possible, spinning the wheels. So they're never really attacking the principal because they're always in the first 3 to 5 years of that loan, they're paying predominantly interest and they're getting frustrated, the lack of progress. They think that they can interest rate their way out of this. Very little do they know that every time they go and refinance for a cheaper rate, they're going back to the start of a 30-year marathon. That is where the most amount of interest is calculated, and they keep getting stuck in this cycle, what I call the debt treadmill. There is a way out of it. It's all about how to structure your loan, and you actually need to do the exact opposite to what everybody's telling you to do out there, because everybody is telling you to do what they want you to do because they are financially incentivized to keep you in debt. Nobody makes money when you pay your house off. And as a result of that, that's where that minimum repayment is very, very positively enforced to make sure you just make your minimum repayment, you got a cheaper rate over here, you think you're actually getting a better deal or a cheaper mortgage. It's actually more expensive than a mortgage you just came from, even though the rate's cheaper because the loan term is longer. So don't listen to the banks and brokers telling you just to make the minimum repayment. It's not going to help you, it's not going to help your family, and it's not going to help you aggressively attack that principal. You want to optimize every single dollar you earn and flood that principal with your income. The second mistake Australians are making that is keeping them stuck financially is stashing their savings in the wrong place. Now, some Australians are putting their money into a savings account or a transactional account or a Visa debit account. Now, banks pay 0.01% interest on those. That's not 1% or 0.1%, it's 0.01% interest on a bank savings account or a traditional transactional account. Now, if you've got money sitting there and the whole meanwhile you're being charged interest over in your home loan at 5% or whatever it may be, like that same $10,000 in savings, for example, sitting in a 0.01% interest account versus a 5% interest account, like it's mind-blowingly more effective to have your salary, your income, your savings sitting in an account where it's working for you and not the bank. Now, the banks and brokers will tell you to put into an offset account. Why would that be? To help you? Maybe, or maybe not, because they can re-lend that money back out when it's in your offset account. And so banks are very keen to have all your money sitting in an offset account. They can re-lend that out to other customers at credit card rates of 16% or car loans at 10%, or even back to other customers for their home loan at 5%. The third mistake keeping Australians stuck financially, it's called lifestyle creep. What's lifestyle creep? It's basically when you get a pay rise, your income increases, but so too your expenses increase. And so we've got a lot of people around Australia who are getting a $5,000, $10,000, $20,000, $50,000 increase to their salary. And as a result of that, they now just get the better quality bottle of wine. They get the nicer car, they get the bigger mortgage, the bigger house. And so you're all earning more than what you were earning 10 years ago. In fact, if I had told you 10 years ago, you're gonna be earning what you're earning right here, right now, and you don't have any money left over, you would have said, there's no way, Scott, absolutely no way. If I was earning that amount of money, I would have plenty of surplus. No, lifestyle creeps crept in, and now you're in a position where you're spending what you're earning. You always have spent what you've earned. And as a result of that, as your income's gone up, your expenses have gone up, and you haven't been able to trap that surplus and put it off the principal or put it towards investments or superannuation, that's growing. And so as a result, that lifestyle creep has cost you dearly over the last few decades or however long you've been working for. And so one of the keys there is if your income goes up, to actually dedicate a percentage of that towards investments or loan repayments, investing in debt or investing into your assets such as super, etc. And so prime example, if we have a client who's got a let's call it a $5,000 pay rise for the year, we then say to them, okay, 50% of that's going to be put towards investments and the other 50% can be put towards lifestyle. So we're splitting that pay rise so that lifestyle creep doesn't chew it all up. And what that means is you're in a position where your debt's coming down faster and or your assets, superannuation funds, etc. are going up quicker, but you're also getting the benefit of a little bit more better quality of life. And so that lifestyle creep is crippling Australian families. Everyone thinks if they're earning more, everything's going to be different. We've got so many clients who work in the mines or on the oil rigs, the fly in, fly out workers. Their mindset is all I've got to do is go and get a better paying job and everything's going to fall into place financially. They sacrifice time away from their family, their friends, they're missing out on birthdays, Christmases, all those really quality family experiences because they want to get that higher income, but all of them are stuck there, still not able to come home, be with their family, get a job in the city because they haven't actually used that uplift in their income to put towards assets or paying down debt aggressively. They've used it to fund lifestyle, jet skis, boats, utes, you know the drill. So that lifestyle creep is one thing to be very careful of. Just make a promise to yourself or a pact to you, and if you've got a partner, to each other, say, hey, any pay rises from this day forward, we're going to quarantine 50% of that pay rise, put that towards investments, assets, paying down debt. The other 50% we can put towards lifestyle, better qualities of wine, holidays, those sort of things. But it's about balance. And so no one's really consciously doing that. And as a result, they're always spending what they're earning. And even when they are getting the increased income over years, it doesn't move the needle. They're not left with all this money stashed, building up in their actual offset account or equity in their property or their superannuation fund going onwards and upwards to higher and higher growth. So that's what we need to do. Mental, 50% of each and every pay rise from here on in is going towards investments, paying down debt, and the other 50% is just going to be towards fun and lifestyle and call experiences with family and friends. The fourth issue that's keeping Australians stuck financially, spinning the wheels, frustrated with the lack of progress, is the wrong loan structure. And you've all been in this position where you're speaking at the barbecue with your brother or uncle or friends, and so what are you doing? First question is rate. What's your rate? Wrong question. You need to be asking, how's your loan structured? What system do you have in place to manage your money? Now, one thing I can promise you is if you don't and aren't managing your money, there's no way you can control or grow your money. And so a lot of people are like, oh, well, I don't have to worry about managing it all. I just know how much comes in. But yeah, you don't have a system for that. You don't have any money management system or strategy in place to optimize every single dollar you're earning. And so by not having the right loan structure, that's putting you in a position where you've probably got an offset account, you're probably paying weekly payments, you're thinking, I'm doing what everyone at the barbecue is telling me to do, but it's just still not moving the needle. I'm still not out of debt in 12 years, which is our average client's loan term. Not 30, 12. And so everybody in Australia is on an offset account. Everybody in Australia is paying weekly payments. And 60% of Australians are retiring with a mortgage. And guess what percent of Australians have an offset account? Wrong structure, wrong strategy, and that leads me to number 5, no plan. Everyone's drifting along, just doing what the bank and brokers telling them to do, refinancing every 3 years to get a cheaper rate, trying to interest rate their way out of this debt, haven't you worked out it doesn't work that way? You've had your loan for more than 3 years. You haven't moved the needle. You've got a cheaper rate. That still didn't move the needle. You're doing everything everyone's telling you to do, but you're not actually paying your house off in 12 years. If you're in a position like that, does sound familiar, you are frustrated, I've seen this 1,000 times. You need a plan. You need a debt-free date. You need to know exactly what your debt-free date's going to be, and you need to measure that. And so each and every month, am I on track to hit that debt-free date? Am I fading, or am I ahead of the curve there? So by having a plan in place and the right structure, you're at least half a chance to retire debt-free. If you don't retire debt-free, do you know what happens? You have to cannibalize your super fund to pay down your home loan. What does that mean? Now you've got nothing left in super to fund your lifestyle in retirement. And once you run out of super, you're now on a pension, and the pension's like $600 a week or something like that, depending on your situation. That's existing in retirement. You're not living, you're not traveling, you're not doing anything. You're existing. $600 a week? Are you shitting me? You can't buy anything for $600. You can't go anywhere for $600 per week. So get a plan in place, get a debt-free date, get a structure, actually have a money management system that automates all your money. You don't have to worry about it. You don't have to think about it. It's just on autopilot. Like, we are lazy by nature. And so I've set up a money management system with a plan that's automated for me. Everyone's so busy with family and work and all the stuff that's super high priority. This is very, very high priority. It's not urgent, and that's why it doesn't get looked at. It's always on your list of to-dos, but it's never at the top of the list to set up a money management system and a plan and a structure with a debt-free date and to measure and track all your progress. I mean, you don't know your savings rate? What? You don't know your net worth? Oh, interesting. But you think you're in control of your money. You don't know any of your numbers. And so one of the things we've seen that allows our clients, or a client of ours, to pay their house off every 28 days. I'm calling a client, say, paid your house off today, Mary. Congratulations, you're free from mortgage prison. Do you know what Mary did? She had a plan, she had a structure, she knew her numbers, and she had a debt-free date, and we aggressively attacked that principle for her, and she's living free from mortgage prison. And if you want to be doing the same, check out the link below, click, see if we can help out. We'll run your numbers and just see if we can also improve your financial position like we've done for 6,500 Australians over the last 20 plus years. What we do works, it's proven and it's tested, and there's no better proof than having a client pay off their house every 28 days. And that for me is the most incredible freedom experience of, I'm free from mortgage prison. I now have my mortgage payment to put towards lifestyle and experiences or investments, whatever you want to be doing. It changes everything the day you don't have a mortgage. So thanks again for taking time to learn more about what you need to be doing to take those 5 financial mistakes out of yours and your family's financial future.